Today we're going to look at the 5 C's of credit and everything you need to know about getting your loan approved first time. Stick with this to the end because you're going to find out the one thing that most people get stuck with. Jaden, tell us the story about Sarah and what's actually happened here.
Yeah, so Sarah contacted me last week. She was in a bit of a frantic panic. She'd spoken to a bank only a year before and they said, yep, Sarah, you're good to go. Here's your borrowing capacity. It's $500,000. You're good with your deposit. You're ready to go. Fast forward to this year, her landlord's put up her lease. She thought it's time to move on. It's time to buy my own home. Contacted her bank and said, hey guys, nothing's changed. My income's still the same. Deposit's actually gone up. I'm ready to go. But the bank came back and said straight away, there's no go. You've recently changed jobs and that job's casual, so we're not gonna accept your income and you're gonna have to wait 6 months to come back. And that's where Sarah contacted us. Fortunately, we've got different banks, have different policies. In this case, we had a bank that was fine with Sarah's situation and could get her the home that she wanted. And that brings us to the topic for today's video. It's how a bank sees you when you're making a loan application. Banks don't look at everyone the same, and everyone's situation is always a little bit different. You might have only been in for your job a certain amount. You might have moved around a lot. You could have a lot of credit cards. You could have none. And the banks assess everyone differently.
The banks are looking at 5 things when they're assessing an application in determining whether they're going to give you that loan or not. We're going to run through every single point. So when you do go ahead and look to get a loan, you know what exactly the banks are looking for. There's 5 things. We call them the 5 C's of credit. Let's start off on the top with character. Jaden, let's talk about what this one entails.
Character refers to your trustworthiness or your reputation. Banks and lenders want to make sure that you're reliable and the money that they give you is going to get paid back. So for this, they look at your character and what you've done historically.
The biggest one for this one is your credit files. So you'll note that the credit providers actually have 24 months history of a lot of your payments, credit cards, personal loans, even Afterpay. If you miss repayments, that's going to be listed on your credit file. And the banks are looking at this for your character. So if you've missed payments in the past, this could really affect your ability to secure a loan. If you had defaults, bankruptcies, the banks will look at that and say, you've shown poor character in the past. For that reason, we're not going to give you a loan.
And this is where a mortgage broker can help because you can help mitigate some negative characteristics with positive ones. So say, for example, in that case, Nathan, you might have had one missed repayment on your credit card. And the reason might have been it got sent to the wrong address. It was a small amount. It might have been a fee that overcharged. We see it quite often. So what we do as a mortgage broker can say, what's another trait? What's something else we can show the bank that shows character? And something that could help is rental history. So you might say, all right, Nathan's had a missed repayment on his credit card from 2 years ago or 18 months ago. That doesn't look good, but here's 5 years rental history and he's paid it on time every time. Bank, we're mitigating that point and generally they'll be happy to consider.
Jaden, if you had the money in a different account and you just didn't transfer it on time, that's another mitigating point. You had the cash there, you just didn't transfer it on time, or the direct debit was delayed. So there's a bunch of things that can mitigate around any character issues, but that's step number 1. When the bank looks at your application, they're checking your character, they're looking at your credit history, and they're seeing what sort of record you have and how likely it is you're going to repay the loan that they give you. The second criteria the banks look at is your capacity. Jaden, run us through what capacity is.
So this is where Sarah got caught short. Capacity refers to your ability to pay back the loan. Banks and lenders generally want to make sure that you've got stable, consistent income to be able to pay back any loan you've got, and also adding on future interest rate rises.
Now, we've seen capacity be a real issue recently with all the rate rises. Borrowing powers dropped by about 30% in a lot of cases, and this is one that the banks are hell-bent on. You must meet their capacity assessment. If you don't, they won't give you a loan under any circumstances.
Now, this is where a lot of people also ask about living expenses because your capacity isn't just your income, but it's your income minus all your expenses, your private health, your food, your electricity, all that other stuff. And the money that's left over, the surplus, is what's used to pay for your loan. Now, there are different banks that assess things differently. Some banks genuinely are hell-bent on looking at every single expense in your account, Netflix, gambling, whatever you've got, and they will take that off and that will reduce your borrowing capacity. There are some others, however, that will look at it on its merits and say, we had a pretty expensive month over Christmas. We understand it was a bit of a one-off. You've gone traveling, you've gone on a holiday. As a broker, we can explain that to different banks. They can understand, well, that was actually just non-recurring sort of expenses, and it will help increase your capacity to borrow.
Moving on to the third thing that the banks look at, which is collateral. Jaden, run us through what collateral is.
Collateral is the security or the actual physical property that you're going to buy, potentially live in or invest in. So banks have different risk tolerances. Generally, if you're buying a home to live in, it's a bog standard house on land, they're going to be happy with it. but they're not going to be happy with it if it's in a flood zone or if it's in a mining town. It could be near high power lines, which pretty much restricts the market they're selling to. We can also see another common one we see is studio apartments. If it's in a city, I guess the tricky part with that is there's less people to sell at the end and it's a higher risk property.
Now, we see this a lot where people are pre-approved, they found the perfect property, and then the bank looks at the collateral and they say, no, this is not a property we accept. A classic example is this: some lenders have a development register. So if you're buying a high density property, meaning a property with multiple stories, maybe in a city, the bank could say, no, we're not going to lend on that property because we've got too many properties already we've lent in there. We won't lend above 25% of the property or the unit itself, which means you'll never know if you'll actually qualify on a property that you like until you tell the bank the address you like. That's where working with a mortgage broker like ourselves can help, because the bank provides us with those registers for developments that they won't lend on, and you'll know automatically upfront if that collateral is going to be suitable or not. Now, the fourth thing that the banks look at is conditions. Jaden, what does that actually mean?
So conditions aren't just the terms and conditions of the loan. They can be things like the loan term, the repayment type, how you're setting it up. So where this might be more common is once you're aged over, say, 45 years old, some of the banks are going to start to say, we're giving you a 30-year loan term. You're going to be 75 when you're paying this off. Can you actually afford that? Do you have super to cover it? Do you have a downsizing strategy? They're going to ask all these things around your exit strategy to make sure that you don't get to 70 years old, you're not working, and you can't afford that loan that you're taking out.
Now, a big thing that banks look at is what's called an exit strategy. So let's say you're 50 years old, you're trying to get a 30-year term. They're going to say, what's going to happen once you hit retirement age, and how are you going to pay off the debt that you owe the bank? Things like using your superannuation, downsizing, they're all common things, but they're going to ask questions. And once again, working with our mortgage broker like ourselves, we can look at your situation, help you determine what a plausible exit strategy the bank wants to see is, and then go ahead. Interestingly, not all banks have the same retirement rule. We've got lenders that will still give you a loan for a 30-year term, even at the age of 60. So once again, it's important to work with the right bank and not go down the wrong path where you will have issues because the bank determines your exit strategy is not being suitable. And the fifth and final thing that banks look at is your capital. Jaden, what does that mean?
So this is the money that you're actually putting into the loan. Your deposit, in other words, it can even look at your assets. So a common one we see where if you're a 50-year-old person, you've only got, say, a 5% deposit and you don't have any super, you don't have a car, you don't have any current contents, you've got no other capital or savings or assets on your assets and liabilities, the banks will tend to ask questions. So my biggest tip here is going to be when you're filling out the application form with the mortgage broker, when you're doing that initial fact find, include everything. So include your home contents, your bike, your jewelry, your art. If you've got a business, goodwill, anything on there that's potentially capital that you've saved, any assets that you might have, gold, cash, etc., include it in there, because the bank's algorithm will look at that and say, Nathan, here's a 30-something-year-old person. At this age, we'd expect you to have this much in assets. And if you don't meet one of those 5 C's, and it's going to cause issues for you. Now, the thing with any of these 5 C's, as we covered earlier, they can all be mitigated if you know what to do. A common one might be, say, bonus income, where you might have only got bonus in the last couple of years. It might be up and down, but if you show the bank, say, 5 years history, you get a letter from your employer saying, yep, Nathan's going to get a bonus in the next 6 months. We think it's going to be this. Things like that can help mitigate your application. And that's where a mortgage broker can help.
Here at Hunter Galloway, we get mortgages approved. So if you're looking to work with a great mortgage broker, hit us up. We'd love to help at huntergalloway.com.au or call us on 1300 088 065. Until then, guys, we'll catch you next time.